Welcome, everyone, to the Adjusted for Risk podcast here from the very, very snowy shores of South Lake Tahoe. So it goes without saying that 2022 was a very interesting year, to say the least, for financial markets, and one that won't be forgotten for some time. Both stocks and bonds were down double digits in the same year, and that marks the first time ever that both stocks and bonds were down double digits in the same year. While equities experienced one of its worst years ever, the Bloomberg US Aggregate experienced the steepest drawdown ever. So investors faced a war in Ukraine. The Fed increased interest rate at its steepest pace in 4 decades. Inflation spiked to 40-year highs, and then you had mortgage rates more than doubling throughout the year. So you had a lot of uncertainty, a lot of issues that investors had to face, and that resulted in a steep market sell-off and heightened volatility throughout the year. So here are some noteworthy market dynamics that played out during the tumultuous 2022 that I found interesting, and I think you might as well. So let's start at the macro level. The S&P 500 fell a negative 18.1% during the year, which was the worst year for equities since 2008. During the great financial crisis, when the broad market index fell 37%. We take it a step further. It was the 7th worst year going back to 1931 in the Great Depression. Now, if that wasn't sobering enough, let's look at the number of negative trading days in 2022. So the S&P 500 experienced 143 negative days in 2022. Let me say that again. It had 143 negative trading days in 2022. Compare that to 125 negative trading days in 2008 during the Great Financial Crisis. Okay. Furthermore, that 143 negative trading days for the S&P 500 was the most since 1974. So typically as we know, when equities fall so steeply and there's that much volatility, investors typically are able to find some solace in bonds, but that wasn't the case in 2022. Now, Bloomberg US Aggregate fell 13%, marking its worst annual return since its inception in 1978. The next worst year for that bond index was in 1994. And guess what it fell? It fell a paltry negative 2.9%. So when you think about that, that's pretty remarkable that 2022, the Bloomberg US Ag fell 13%. The next worst year was a negative 2.9%. That's just how bad it was for fixed income. And as you know, the Bloomberg US Aggregate is made mostly of treasuries and investment grade bonds, so it's not all that risky. Furthermore, its drawdown, the Bloomberg US Ag's drawdown of negative 17%, was its largest ever. This was the worst year on record for that investment grade index. Meanwhile, that supposedly safe US treasuries plummeted as interest rates climbed from historically low levels, resulting in falling treasury prices. This resulted in the Bloomberg 7 to 10 year Treasury index falling almost 15% during the year. Some may think, well, it was supposed to be safe. Falling nearly 15% isn't what they'd want in a safe investment. So that dynamic of falling equity and bond prices together resulted, not surprisingly, in a spike in correlation between the two asset classes. The 12-month correlation between the two spiked to 0.76 in September, which is the highest since the end of 1997. This increase in correlations between those two primary asset classes really hindered the performance of the 60/40 portfolio, or for that matter, any investment portfolio that contained equities and bonds, or potentially even risk parity portfolios. The 60/40 portfolio fell nearly 16% during the year, which was the steepest annual decline for that 60/40 portfolio since the great financial crisis in 2008. In its second largest decline since 1980. So it's no wonder when you see that performance, that type of performance, that there were calls saying the 60/40 portfolio was dead, which I believe was a little premature at the time. And I have said in my 2023 Outlook piece that I believe the 60/40 portfolio will make a comeback in large part due to the opportunities in fixed income now that interest rates and yields have climbed, in most cases above 3.5%, even 5% and so on. So there's some opportunities there in fixed income moving forward. So that 60/40 portfolio might provide some opportunities again for investors. So getting more granular, let's take a look at the popular growth versus value performance. As you know, growth has driven markets really for the past couple of decades. Growth has outperformed quite heavily over value, for some time now. But that changed. Value outperformed growth by over 20% during the year, which was the largest outperformance for the value style over the growth style since the dot-com bubble. Growth has benefited, like I said, growth has outperformed over the past couple decades, and that was a result of falling interest rates over the past 20 years. So growth really benefited from those falling and historically low interest rates. Well, that story flipped as the Fed hiked interest rates, which hurt the growth style and benefited the value style in 2022. All right, so now let's go ahead and take a look at the ongoing, ever popular debate between active and versus passive management. Conventional thinking is that active managers outperform during times of heightened market volatility, which really hasn't been the case over the past few years. Volatility has increased during short periods of time, and passive managers have still outperformed. So while passive managers tend to outperform when markets are trending higher with lower volatility, as the tide is raising all boats, well, 2022 was a good year for active managers, as a very large percentage of active managers outperformed the respective benchmarks during the year across value and blend styles, regardless of the size. So active managers really took advantage of that heightened volatility, especially value managers and blend managers. Roughly 80% of all mid-cap value, small cap value, and small blend active managers beat their respective benchmarks, while over 70% of all large value, large blend, and mid-cap blend managers beat their benchmarks. Meanwhile, on the flip side, active growth managers, they struggled to beat their respective benchmarks during the year, despite it being a very tough year for that style. Usually when it's a tough year, the bogey or that benchmark that these active managers have to beat is lowered. But that necessarily wasn't the case because only about 35% of active large growth, mid cap growth, and small cap growth managers beat their benchmark in 2022. So another interesting dynamic played out in comparing large caps and small caps. When comparing the basic Russell 1000 versus the basic Russell 2000 indexes, the Russell 1000 index or large caps outperformed small caps by roughly 1.3% during the year. And when you consider the risk-off environment, all the uncertainty, all the volatility, that result might be a surprise to some. Investors had to deal with a lot. Like I said earlier, there's high uncertainty, high inflation, the rising interest rates, the war in Ukraine. So it might surprise some that the riskier small caps held their own against the perceived safer large caps. Taking a step further is even more interesting. When comparing the mega caps, those super large companies, or the Russell top 50 versus microcaps or the Russell microcap index, those very small microcaps outperform the 50 largest stocks by over 2%. So on the surface, that may be a surprise, like I said, considering the high volatility and how risky those microcap stocks are. During times of high volatility and uncertainty, most people would flight to safety or things that are less risky or perceived to be less risky, and you would go to large caps. That wasn't the case. So when you dig a little deeper, the top 50 names have a high representation of big tech names. And as we covered previously, those mega tech names really struggled in 2022, while small cap indexes have a higher representation of financial stocks or value stocks, which outperform. So that outperformance by the smallest stocks compared to largest stocks may not be a surprise when you consider what makes up those indexes and the fact that financials or value stocks benefited from rising interest rates, which gave them a little boost in performance. Now let's move along to asset classes. It's no surprise here that commodities were the best asset class with a return of 17%, while cash came in second, and it was the only other asset class in addition to commodities that finished the year in positive territory with a 1.4% return. Meanwhile, the worst asset classes in terms of performance in 2022 was REITs with a negative 26% return during the year. And that was followed up with emerging markets with a negative 20%, nearly 21% return or fall. And what's interesting is even tips, which you would think would perform okay, or that would be a place that people would go to hedge against 40-year high inflation, tips fell a negative 12% during the year. So as for equities or equity sectors, not much of a surprise here, as there were only two S&P 500 sectors that finished the year in positive territory, with the energy sector represented by the S&P 500 Energy Sector Index posted a whopping 65% return, and the utility sector posted a 1.5% return. Those were the only two sectors that had positive performance. Meanwhile, the worst performing sector was communication services, which fell nearly 40%, followed up by the consumer discretionary sector, which fell 37%. And that popular information technology sector or tech fell 28%, which, again, those results probably aren't a surprise when you consider growth. The growth stocks greatly underperformed value. during the year. One comparison I always like to look at is the performance between the equal weighted S&P 500 versus the cap weighted S&P 500. The cap weighted S&P 500 is the most popular version. This is the version that is used as the typical measure of the US stock market. This is what you see when media references the stock market, is the cap weighted S&P 500. So while the cap weighted version is the most popular, it can often be skewed due to the high weighting in the top 10 holdings. And that's what we've really experienced since the pandemic. A high concentration or a high weighting in the top 10 holdings. And that recently has been made up of mega tech stocks. If you look at the top 10 holdings of the S&P 500, the cap weighted, it is overwhelming in terms of the number in the large weight of tech stocks that make up the top 10 holdings. So one could argue the high concentration in top 10 holdings doesn't make for a very diversified index. The equal weight index, conversely, of the S&P 500 outperformed the more popular cap weighted version by over 6.5% during the year. Again, this highlights the difficulties the mega tech names had this year, as that very popular tech trade during the early stages of the pandemic unwound this year in grand fashion, while the equal weighted version, which is much more diversified, it gives each one of the 500 names that make up the index an equal weight, helps alleviate those concerns as more diversified. So it's not surprising that the equal weighted version of S&P 500 outperformed the cap weighted by such a wide margin during the year. Another interesting performance dynamic that caught my attention was the performance of the different equity factors. The value and dividend factors were the best performing, as the MSCI USA Value Index fell a negative 6.2%, while that similar MSCI USA Dividend Tilt Factor Index fell a negative 7.67%. So yes, they fell, but it shouldn't really come as a surprise to many that those were the best performing factors when you consider the uncertainty, the volatility that investors had to face with. So especially the dividend factor, as consistent dividend paying stocks tend to be more resilient during a market sell-off and uncertainty. What did come as a surprise was the performance of the quality factor. MSCI USA Quality Index was the worst performing factor in 2022 with a negative 22.6% return. So one would think during times of uncertainty and a steep market sell-off, those high quality stocks, high quality funds that focus on consistent cash flow, free cash flow, strong balance sheets, consistent dividend paying stocks, should be able to withstand the volatility and be more resilient to an economic slowdown and all the uncertainty. That wasn't the case this year. That kind of goes to show you what type of year 2022 was, and the uncertainty and all the different market dynamics that investors had to face. That really wasn't what you would think compared to historical precedents. So it is clear that 2022 was a very noteworthy year for numerous reasons. And in the future, I think market pundits and strategists, they're going to compare future years to 2022. It's never good when a statement starts with, was the worst year since, the great financial crisis. And moving forward in 10 years, 15 years, investors and market strategists, they're going to probably be saying this was the worst year since 2022. That's the type of year it was. So with that, thank you very much for watching and listening to this episode of the Adjusted for Risk podcast. You can find additional episodes on our Adjusted for Risk YouTube channel, as well as the show notes and other insights at our Wealth of Insight from 6,237foot.com blog. So thank you very much again, and I hope you all have a great rest of your week.